Joining us now is Canaccord Chief Market Strategist Tony Dwyer. Tony, good to have you. So this market thus far in 23 has caught you by surprise, how good it is. You're saying to keep some cash, waiting for a recessionary pullback. But for those playing at home, how much extra cash and how long are you going to wait?
Well, so it's a great question, and I think it's important to differentiate the market. I think Mike had a great comment, John, a little bit earlier about the real bull story here is you take a little bit of profit out of the mega cap names and throw them into the smaller and equal weighted indices, and it doesn't take a lot. If Apple is as big as the entire market cap of the Russell 2000, it doesn't take a lot to move those smaller cap names, and you're getting the money flow there to do it. So that's a great question. What would it take? And our call has been to be what we call light and tight. 18 months into this, we've been defensive for the better part of the last 18 months. 18 months into this, now's not the time to go out and get short and get really negative. It's the time that we're looking to be a little bit lighter in exposure because you're getting paid to wait with cash. But you also want to have some cash if you do get this recession-based or bad news becomes bad news drop to take advantage of it because it's with lower interest rates that happens. So that's where I think I've made the mistake this year is the outlook for lower inflation has given a better lift to those mega cap stocks and now some of the cyclical names versus the higher interest rates. That's what has surprised me a little bit.
So you mentioned inflation. What's the most important thing investors are going to learn from CPI tomorrow? It's going to influence your timing.
John, it won't. It's like the employment numbers. It is stunning to me that we trade the market so actively on numbers that get so highly revised. So I try to look at the trend of the numbers, and the trend of inflation is better. John, it's supposed to be better. If you're having an period of economic weakness, which even though it's been better than expected, it's still weakening, you should have, especially given the base effect, and for the viewers that aren't familiar with that term, that's when you roll out the year ago level, so it changes because of you're rolling out that higher number, it changes it and makes it more attractive. But you're supposed to have lower inflation at this point. It's not being reflected in short-term interest rates, which I think has caught myself and some others off guard. But again, 18 months in, you're looking to take advantage of weakness. You're not looking to bet on it. That's been our call.
Why do you think that hasn't been reflected in short-term interest rates? Is it just because the Fed has continued to be hawkish and you have something like another hike in play now for July, or is it something else?
Yeah, I'm a little bit baffled by that, Morgan. I'm going to break the cardinal rule of strategists and say I don't know. There's times so that, as you know from my note earlier this week, the summary line was when you're on a muddy road, don't jerk the wheel. So when you think about the market, the Dow Jones Industrial Average is up about a little under 4% so far this year. The New York Stock Exchange Composite is up about 4% this year. So you really have to differentiate what market we're talking about. That said, there's been, I called it the hustle and the rustle, starting in June 7th when we put out that note. You are seeing this money flow and broadening out of the marketplace that is kind of going in the face of higher rates. And I like to think about the line, Morgan, don't fight the Fed. Why isn't it follow the Fed? Because we fight the Fed every time. So again, I think we do have this period where we're going to go into a recession. How deep it is going to be dependent upon how quickly the Fed starts to cut interest rates.